What is going on, guys? It's Enzo, finally coming at you guys with a YouTube video. I just wanted to come on here and do a basic overview of my strategy. I'm going to be going over how I find my daily bias, as well as some of the key concepts and confluences that I use in my trading. Like I said, it will kind of be a more basic overview, but it's still going to be a lot of the core stuff that I use. I always find that simplicity works in trading, so yeah. With that being said, let's get into it. The first thing that I do every single day when I'm trading is I form my daily bias, and I'm always working from high time frame to low time frame. So what I'm going to do here on the daily bias, the high time frame, is I'm going to find what I believe the larger play at hand is, where the liquidity is drawn to, at least initially. So with that being said, what I'm looking for is a close above or below a previous day high or low. So in this case, as you guys can see, this candle right here has closed above this previous day high here. That means we should be bullish. Usually it's going to be drawn to the high of day or higher. In this case, we're basically already at the high of day, but I would still be bullish in general. Now, once again, for the exact same reason, I would be bullish because we once again closed above this previous day high. Okay, and I would be bullish once again to the high of day because we closed above this previous day high. A lot of you guys might be wondering, what happens if you close within a high and a low, kind of like this? Well, that's just kind of when this method won't work. This is to find defined draws of liquidity. Not every day has a super defined thing. Some days are harder to read than others. This, like everything else in trading, is a probability. But I would say upwards of 8 out of 10 times when you have a close above or below a high or low, you can use this to accurately find the draw of liquidity. Now, we would be bullish again, like I said, to the high of day or higher, because every time we close above previous day high, we're drawn to bullish, high of day or higher. If we close below the low, we're going to be drawn to the low of day or lower, if that makes sense. Okay, once again, I would be bullish to the high of day or higher. However, when you start seeing these candles get smaller in size and not making, as much progress upwards as these previous ones, that's kind of how you're detecting a resistance potentially forming up here. So we could see it start to form bearish. That being said, we did close above a previous day high, so I would be bullish and try to take this high of day. So it took the high of day and higher. Like I said, it would be bullish. There was more ticks upwards than down, it looks like. But as you can see, it did technically close bearish. Now this is a doji candle. I'm not going to really get into explaining what that is, but this doji candle would typically indicate a reversal is coming soon. That being said, it may not necessarily go bearish yet. We did close above this closed high here, so I would honestly think that we can still hit this high of day or higher since we got above that closed high. So as you guys can see, it was bullish still. Even though we saw potential resistance, it looks like it got supported from down here. And I would be once again bullish to this high of day or higher here. Okay, so we took the high of day and higher. However, the candle was predominantly bearish. This would, I would assume, off open, it ripped towards this high of day. That would have been your liquidity draw. And then it went bearish from there. So now that we've closed below this previous day low, like I said earlier, we would be bearish to the low of day or lower. That being said, you would want to be aware that we have fair value gap. This is going to be green. This is bullish. We have fair value gap and imbalance working as a support here, as well as here, that price could basically come into and then reverse. So I would expect it to take this low of day and potentially a little bit lower, but we would really want to see it support within the top half, the upper equilibrium of this fair value gap right here. So let's see how it plays out. Okay, yeah, it's pretty much exactly what I was looking for. It did get the low of day and lower, so I would have taken the short to there, and then I would have looked to longs. I would have waited for longs from there, which I would have waited for the confirmation of the reversal off of this fair value gap. All right, so now that we know how to use the daily time frame to form our bias, let's take a look at the concepts that I actually use to execute my trades. So typically I will be on the 5-minute or 1-minute even to execute the trades, but I'm here on the 1 hour to show you a lot of solid examples of the following concepts. Now the following 3 are always what I use to enter. I use at least one of these in every single entry, at least typically. So these are the order block, breaker block, and fair value gap. The order block is what we'll start with. It's what I have highlighted right here. The way that we can indicate an order block is formed is by equal lows, increase in volume, and the formation of an imbalance. So that imbalance is going to be the fair value gap, one of those other 3 concepts I just mentioned. So the fair value gap is an imbalance that occurs when you have 3 or more consecutive candles, and it's going to go from wick to wick. So it's going to go from this wick to the wick right here. So it's an invisible gap between 3 or more consecutive candles, excluding wicks. This is the fair value gap. What you want to do is basically use these as in conjunction typically, because the order block always precedes fair value gaps. Not every fair value gap has an order block before it, but the order block always is followed by an imbalance. So when an order block forms, you may not know until that imbalance is formed. The way that you would want to do it is to enter longs on top of the imbalance. So this could be your entry, and then you would want to stop loss at typically the bottom of the candle, including the wick if there is one. Now this would be extremely risky on a 1 hour time frame because the candles will be large, but typically on a 5-minute time frame, you can get a ton of RR, really good setups, especially if you use the stop loss rule. I would caution you to include that wick, because if you do stop loss using just this green box and stop at the actual fair value gap, a lot of times price will perfectly sweep it before continuing, and you would hate to get stopped out and then watch your bias continue without you. I definitely don't like when it happens to me. Now, what I'm drawing out here are more fair value gaps, and we're going to take a look at more bullish and then bearish examples of both fair value gaps and order blocks, as well as take a look at breaker blocks. So as you can see, when I draw out these FVGs, price is going to be supporting within all of them. I'm going to drag them out even further here. Just give me a moment. So in these lower examples, as you can see, price resists not only right here, but also here, and then down on the right here, we saw a resistance here on that higher order block, and then we see resistance right here, 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 here. Well, it's really there. And then down here we see resistance, and even right here, yeah. So all of these wicks tapping off is resistance. These are all order blocks and fair value gaps. Now the difference between them is when an FVG, fair value gap, is mitigated, meaning irrelevant, it's because price is closed through it. So the moment that price closed right here under that fair value gap, that fair value gap was no more. Now this is the support that it wants to test up to. And as you can see, it's supported right here as well. Or rather, resisted. Because instead of being a bullish support like we saw right here, we now have a bearish resistance. That is because rather than a fair value gap, how it gets mitigated and completely irrelevant once price closes through it, when price closed through the order block here, this bullish order block became a bearish breaker block. So now, rather than price supporting off of it like you saw right there, you're going to see price resist under it, like you see there as well as here. That is breaker block, order block, and FVG. And we're going to take a look at some more examples up here. But you can essentially see that inside of this OB formation, you see resistance here, 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 and there. You have another OB formation here where you have resistance here, here, and yeah, essentially all of these fair value gaps and order blocks. There's a ton more that I haven't charted right here. Bullish, bullish, all FEG up here, bullish FEGs, bearish FEGs here. Another good example right here I can see that has resistance would be right here. These are not coincidences. Price resisted right in that fair value gap. And every time that price is either supporting or resisting one of these boxes, these are opportunities for shorts or longs. Now, that is kind of how you enter the trades. Now, the way you want to exit them is by targeting these previous confluences. So after we swept from this bearish order block, we tested the bullish order block at the time. This was not the bearish breaker at the time. So we have a bullish order block. When price came down and tested this, you would have wanted to look for longs within this block. After it pushed out and confirmed using fair value gap, you could have taken a long here, stop loss under the fair value gap, and as you can see, that setup would have played out. I would have targeted the order block that had just formed here. So now you basically have a setup that looks something like this. You basically take the long on there. You would stop loss all the way here. You could either use the order block to stop loss or the fair value gap that you entered on, and then you would want to take it to there. And as you can see, that is a clean 8RR example. There are a ton of examples that I could chart out, from shorting right here down to the block, or from longing here up, etc. There's going to be a ton of examples, but I think you guys get the point. This is how you find fair value gaps and order blocks in the market and use them to support and resist positions. Combine this with locating the bias, and as long as you can basically use the daily bias to get a good general idea of your direction, and then use these order blocks and fair value gaps as basically targets, because if you're longing towards a resistance, you're not going to want to bet on breaking it every time. A lot of the times what I would like to do is, let's say I am taking a long and eventually before the high of day, I have a bearish order block or a bearish FEG. I might trim my position right under that resistance, take my profit there, and then either re-enter or let the rest of it trail until either TP2 or I take it on a trailing stop loss, meaning I trail the stop loss tighter and tighter as the trade progresses. This leads to an 80% plus win rate and a lot of profit. So if you guys want to get inside of my Discord and learn how I'm doing this and get more details on my strategy, it is very simple, but I'm sure that there's going to be a lot of you guys who are beginners with a lot of remaining questions. Get inside the Discord so I can help you guys out. Peace.